All right, let's jump right in. We're going to break down one of the most fundamental and, frankly, misunderstood concepts in the stock market. It's the mindset shift that really separates the speculators from the true long-term investors. I get this question all the time. You look at the charts, they're bouncing all over the place like a heart monitor. You hear these crazy stories of people losing everything, and it's a totally fair question to ask. Is this whole thing really just one giant casino? And look, the honest answer is, for a lot of people, yeah, it is. It absolutely feels like a casino because they're treating it like one. They're playing a game of luck when they should be playing a game of business. See, until you really get what you're actually buying, you're not investing, you're just guessing.
Welcome to Money Flow IQs, where money meets learning. We empower individuals to master financial literacy for lasting stability. Our service equips you to make informed decisions about budgeting and saving. Join Money Flow IQs today to achieve your financial goals.
Let's make what I think is the single most important mental shift you can make as an investor. It's all about moving from thinking of a stock as just another lottery ticket to thinking of it as a piece of a real, actual business. This is it. This is the whole ballgame right here. When you hit that buy button, you're not just buying some ticker symbol that wiggles up and down on a screen. You are literally becoming a part owner of that company. You get a slice of their cash, their buildings, their ideas, and all of their future profits. I absolutely love this. Somebody on LinkedIn once jokingly put on their profile that they were a partner at every company they own stock in. And, it's hilarious, but it's also 100% true. You are a partner in that business. So if you're a part owner, think about it. What really matters more? The frantic, second-by-second price flashing on your screen? Or whether the business you partly own is healthy, growing, and making money? This is the pivot. You have to stop staring at the ticker and start digging into the company. And this all leads to probably the most crucial distinction of all. Seriously, once you truly get this, it will change how you see the market forever. And it's this. The price of a stock and the value of a business are two completely different things. Not even close. Okay, think of it like this. You go to a grocery store. A gallon of milk is $3.99. That's it. It's a logical price. But the stock market, it's a chaotic, emotional auction. You've got thousands of people yelling, some are scared, some are greedy, some have just had way too much coffee. And the price? It's just jumping all over the place based on all that noise and emotion. Here, let me give you another way to think about it. Imagine someone installed a ticker over your front door that quoted you a new price for your house every single second. 1 minute it says $400,000, the next it's $350, then it's $450. Did the actual value of your house, the bricks, the wood, the land, did that really change that much? No way, of course not. The auction just got a little crazy. So here's the bottom line. Price is what you pay. It's the sticker price, the noise from the auction. Value, on the other hand, is what you get. It's the engine, the actual logical worth of the business underneath it all. Your whole job as an investor is to find those moments when the noisy price is way below the real value. Okay, so how does this whole price versus value thing actually play out over time? Well, there's this brilliant analogy from the godfather of value investing, Benjamin Graham, that just nails it. This might be one of the most powerful sentences ever written about investing. In the short term, the market is just a popularity contest, a voting machine. Who's the hot stock this week? What's the buzziest story? But in the long run, all that hype and popularity stuff, it just fades away. And the market becomes a weighing machine. It doesn't care about stories. It cares about substance, the actual weight of a company's profits and cash flow. Let's make this real with a classic example. If you go back to the dot-com bubble of 2000, the company that everyone was talking about was Cisco Systems. They were building the plumbing for the internet. You could call them the NVIDIA of their day. The story was just incredible. And man, the voting machine went absolutely wild. At the peak of all that hype, the stock hit $82 a share. Everybody thought it was the future, the first company that would be worth $1 trillion. The votes were in, and Cisco won the popularity contest. Okay, now get this. More than 2 decades later, Cisco stock has never gotten back to that $82 high. If you just looked at that price chart, you'd think, wow, what a total disaster of a company. But see, that's the wrong question, isn't it? We can't confuse the verdict from the voting machine back in 2000 with how the actual business performed. So let's ask the right question. Was Cisco actually a bad business over those 20-plus years?
And this is where the weighing machine comes in. While the stock price was stuck in the mud, the actual business was crushing it. Revenue up 4x, profits up 5x. The business itself got way heavier, way more valuable. It's the perfect example of why the price you pay matters so much. So what do we do with all this? How do we put it into practice? Well, it all comes down to having a framework, a set of rules that helps you ignore the voting and focus on the weighing. It's about tapping into the incredible power of just waiting. Think of these rules as your anchor in a sea of emotion. They're here to remind you that you're a business owner, that value comes from future profits, that you got to understand what you own, that time is your friend, and that, as we saw with Cisco, even the greatest company in the world is a terrible investment if you pay way too much for it. You want to know the hardest part of all of this, though? After you've done the research, you found a great business, you understand its value, you bought it at a fair price. The real challenge begins. And the hardest part is doing nothing. Just sitting on your hands and letting time work its magic. That constant itch to do something is what destroys most people's returns. The late, great Charlie Munger, Warren Buffett's longtime partner, absolutely nailed it. He said, "The big money is not in the buying or selling, but in the waiting." Yeah, buying is exciting, selling can feel good, but the real, life-changing money, it's made in that quiet, sometimes boring, in-between period of just letting a great business do its thing. So I'll just leave you with this final question. Now that you know the difference, now that you see the market not as a casino, but as a place where you can own pieces of wonderful businesses, what are you going to focus on? Are you going to keep getting hypnotized by the emotional noise of the daily ticker? Or are you going to do the real work and start studying the business? The choice is all yours.